You're looking at your paycheck stub, and it feels like a foreign language, a cryptic list of abbreviations and numbers that just shrink your bank account before you even see the money hit your balance. You see the taxes taken out, you feel the sting of the deduction, and you just accept it as the cost of being a W-2 worker. But what if I told you that your employer and the government are essentially holding your own money hostage because you don't know the right forms to fill out? I'm talking about thousands of dollars every single year of real, spendable cash that could be tackling your credit card debt or feeding your emergency fund that you're basically donating to the IRS out of pure ignorance. I remember the exact moment I realized I had left over $4,000 on the table over 3 years just because I didn't know how to claim a simple home office deduction while being a remote worker. That's $4,000 that could have paid off my high-interest student loans years sooner. In the next few minutes, we're going to walk through the tax deductions that most normal income earners just ignore, and I'm going to show you exactly how to capture that money for yourself this tax season. First, let's talk about the home office deduction, but I'm not talking about the kind that gets you audited. If you're a W-2 worker, the rules changed significantly with the Tax Cuts and Jobs Act, but there's a massive loophole for people who are partially remote or hybrid. If you're required to work from home by your employer and you have a dedicated space, you need to check if your state allows for unreimbursed employee expense deductions. Many people think because the federal level changed, everything is off the table. That's a myth. I've helped friends in states like California and New York realize that their home office utility costs and even a portion of their internet bills were deductible on their state tax returns. You're talking about a few $100s of tax relief that effectively boosts your monthly take-home pay. Think about your electricity bill for a second. If you use 10% of your home for work, you could be claiming 10% of your utility costs. That's not a lot, but it's real money. And if you aren't tracking your miles for work-related travel that your company doesn't reimburse, you're losing out on the IRS standard mileage rate, which is currently over 67 cents per mile. I've seen people drive 3,000 miles a year for work-related activities that they don't even log because they think it's only for gig workers. It's not. If your job asks you to drive your personal vehicle to a client's site or a secondary office and they don't pay you back, that is a tax-deductible expense in many jurisdictions. Next, let's address the most misunderstood secret weapon in your financial arsenal, the Health Savings Account, or HSA. An HSA is a tax-advantaged savings account for people who have a high-deductible health insurance plan. High deductible just means you pay more out of pocket before your insurance starts covering the big bills. Most people see the high deductible and get scared, so they pick the expensive plan. But the HSA is a triple threat: the money goes in tax-free, it grows tax-free, and as long as you use it for medical expenses, it comes out tax-free. I've heard from so many of you who are drowning in medical debt, yet you're paying for high-premium health insurance plans instead of maximizing an HSA. If you have an HSA through your employer, they often contribute to it for you. That is free money. If you're currently paying off debt, you need to look at your medical bills and stop paying them from your regular checking account. If you have an HSA, you should be using those funds to pay for doctors, prescriptions, and even over-the-counter items like ibuprofen or bandages. I once saved nearly $2,000 in a single year just by routing my family's dental and vision expenses through my HSA. The tax savings alone kept me from having to pull from my savings account when an unexpected car repair hit in November. If that just clicked for you, hit the like button. It tells me to keep digging into these boring but profitable tax hacks. Now, let's talk about something that hits everyone: student loan interest. If you're paying off student loans, you can deduct up to $2,500 of the interest you paid during the year from your taxable income. A lot of people think this is automatic. It isn't. You have to ensure your loan servicer is reporting this correctly, and you have to claim it on your tax return. If you're in the middle of a debt avalanche or snowball, that deduction is effectively a discount on your interest rate. You're not just paying down the principal, you're getting a break on the cost of borrowing. Here's where it gets real: the avoidance behavior trap. I talk to so many of you who are terrified of taxes. You think if you claim a deduction, you're inviting an audit. You're not. You're simply reporting facts that the government allows you to report. Audit fear is the biggest tax loss generator in America. Millions of people are leaving money on the table because they're scared to be aggressive. You don't have to be aggressive, you just have to be accurate. If you've got receipts for your work-related expenses or your student loan interest statements, that's not being aggressive, that's just being an organized adult. Tell me, what's your biggest debt right now? Is it credit cards, student loans, or something else? Drop it in the comments below. I read every single one of them, and seeing how much debt you're carrying helps me tailor these explanations to be as helpful as possible for your specific situation. You're not alone in this. There are millions of people in exactly your position who feel the weight of these payments every single month. The only difference between staying stuck and building momentum is having the right information. Now, let's look at the educator expense deduction. If you're a teacher, and I know many of you are, you're likely spending hundreds of dollars out of pocket for classroom supplies. The current limit is $300, but I see teachers spending closer to $1,000. You need to keep every receipt for every glue stick, pack of paper, and classroom decoration. Even if it feels small, that's $300 of taxable income that you don't have to pay taxes on. That's a direct reduction in your tax liability. Don't let that slip through the cracks. It's your money, and you deserve to keep it. We also have to talk about charitable contributions. Most people don't itemize anymore because the standard deduction is so high, but you can still make a difference. If you have a decent income and you're trying to lower your tax bill, consider bunching your donations. This means instead of giving a little bit every year, you donate 2 or 3 years' worth of charity in one tax year to push yourself over the standard deduction limit. This is a common strategy for people on the path to financial independence who want to maximize their tax efficiency. It requires planning, but it's one of the most effective ways to lower your total tax burden legally. If you're someone who sends money to help support parents or family members, you might be able to claim them as dependents if you provide more than half of their financial support. This is a massive tax credit that people ignore because they think it's too complicated. It's not. It's a form. It requires proof of support, sure, but if you're already paying for their groceries or their rent, you should be getting the tax benefit for it. I know someone who was paying for their mother's assisted living facility but didn't claim her as a dependent, losing out on thousands of dollars in potential tax credits. That's a mistake that takes about an hour to fix with a qualified tax preparer. Finally, we need to address the passive income tax myth. If you're trying to build wealth on the side, stop thinking that all income is taxed the same. If you're selling stuff on eBay or doing small side gigs, track your costs. You aren't taxed on your revenue, you're taxed on your profit. People get scared away from side hustles because they think they'll get hit with a massive tax bill. If you document your shipping costs, your inventory costs, and your mileage, you're only paying taxes on what you actually keep. That's a huge distinction. If you know someone who's constantly stressed about their monthly paycheck and always feels like they're running out of money, send them this video. Sometimes the difference between drowning and treading water isn't working more hours, it's just keeping more of the money you've already earned. We've covered a lot today, from HSA hacks to dependent credits. Next time, I'm going to do a deep dive into how to negotiate your credit card APR down in 10 minutes, because the interest you're paying to the banks is the biggest tax of all. Keep your receipts, stay organized, and don't let the system take more than it's owed. You're closer to financial freedom than you think. Just keep stacking your wins, one tax form at a time.